It is a strange world we live in. Whoever makes money with investments seems to get labeled as lucky. You were lucky that you bought Bitcoin early. You were lucky that you bought property when the prices were still low. You were lucky when you bought Tesla when it was still not that well developed. Now, what's behind this comment that investment success is just luck? It could simply be jealousy, right? People didn't buy when you bought, and so they're just jealous. Or alternatively, it could be the idea that markets are efficient and that any performance that's above the average is just pure luck. I strongly believe that investing in any market has both a luck but also a skill component. Whatever asset we buy and sell, be this cars, be this property, be this stocks, be this crypto, there's always some kind of an inefficiency. We can also invert the argument, as in, is it possible to buy a house that's clearly overpriced and lose money on this? Is it possible to buy a cryptocurrency that's clearly very bad, that's likely going to go down? The answer to both of those questions is, of course, yes, it's possible to find assets that are not worth investing. Thus, if there are assets that are clearly overpriced, there must also be assets that are underpriced. And so in the end, the game is all about being better informed than the average. It's to use data most people are too lazy to dig out, to analyze. It's to figure out things that most people are not aware of, and then basically exploiting the market, right? Buying low, selling high. Now, there's one extremely useful website for crypto to get an idea of the macro picture, to look at data most people don't know. And that is Onchain.com. Feel free to go to this website yourself and have a look at all of those charts. Each single button on this website is its dedicated chart with on-chain data. How is Bitcoin getting bought and sold? How are people in profit? How much speculation is there currently? The website is completely free. I'm not getting sponsored by anything. I simply just like the things that are shown here. And I want to show some charts that I think are noteworthy. Let's have a look at the Bitcoin active address momentum. It fluctuates quite a bit, so there's a bit of noise in here. That's why you can add a moving average. Whenever the market is very, very heated, for example, in 2017, when Bitcoin hit the 20K, there was a lot of active addresses. Then when the bear market set in, we went from 20K to 3.5K, the number of active addresses fell. And so the market is heating up and cooling down and heating up. Currently, historically speaking, it doesn't seem to be too heated. We can add another moving average to remove even more noise. Of course, then we also get a bit of a delay. But in general, since Bitcoin hit the 60K, it tends to rather cool down. Isn't that interesting? Now here's the same kind of chart, but not for the number of active addresses, but for the number of transactions. So again, a direct comparison. Here are the transactions, here are the wallets. So interestingly enough, the number of transactions went to new all-time highs, while the number of wallets did not. So it seems like the wallets that are active in Bitcoin are now transacting more frequently. There is growth in transactions, not growth in active addresses. Still, when we overlay our moving averages, it is interesting how since November of last year, the transaction activity tends to rather slow down again. Now, the number of active addresses fluctuates quite a bit, but the number of addresses that simply just buy Bitcoin and then hold it for a while fluctuates much less. And that's shown over here. Now, here is the number of shrimp accounts. So all the wallets that have less than one Bitcoin. It peaked in January of 2024 and since then tends to rather decline. The price of Bitcoin, however, did another 2.5x since then. Here's the number of crab accounts. So that's up to 10 Bitcoin, so between 100K and 1 million worth of Bitcoin. That's already getting into wealthy retail territory. But again, since December of 2023, no growth here. Now for fish, we get into the seriously wealthy holders. This is now between 1 and 10 million worth of Bitcoin. Since Bitcoin hit $1,000, the number of such wallets did not grow anymore. So for the last 8 years. With sharks and with whales, we get now into the institutional wallet size. So that's centralized exchanges, etc. But isn't it interesting how the number of people that hold their Bitcoin into self-custody tends to not grow that much anymore? At least the people that have some significant money in the asset. And at the same time, the price continues to rise. So the purchasing demand needs to come from somewhere else, potentially from the ETF, potentially from other institutions. Now, I'm just interpreting the data. I don't know either what's going on behind the scenes, but it's good at least that we know that something is changing in the structure of the market. There's also a change with the duration, how long Bitcoin is held. This here is the HODL waves. So we see Bitcoin supply, which of course grows over time due to Bitcoin mining. And then those colored areas show how long has the Bitcoin been held. So this gray area is for at least 10 years. So that Bitcoin has not moved for the last 10 years. And of course, this area could only start after Bitcoin had already existed for 10 years. If we take away those very long-term holders, then we see that all of the recent issuance of Bitcoin, all of the mining, it didn't have any inflationary effect on the price, because the Bitcoin is probably already lost, or at least in some, it's not really moving anymore. And so that's why people call Bitcoin the hardest of the monies, the hardest of the assets. The additional supply that hits the market is low enough to keep the asset stable. Again, because Bitcoin gets lost at the same rate. We can also normalize this graph to 100% over the entire lifetime of Bitcoin. Then we get this chart here. Again, it shows us a story that over time, there's less and less short-term speculation in Bitcoin. So currently, what we see in this chart now is all the Bitcoin that has been held at a maximum of 1 year, and this tends to decline. Now, of course, there are phases in the market where this is going up, and that's when the price itself is going up. So the long-term holders are selling to the short-term holders, but then when the bear market kicks in, those short-term holders exit again and the long-term holders take over. We see the turnaround quite nicely aligning with the price peak for the holders that hold Bitcoin at maximum for 6 months. So we had a cycle peak at the end of 2017. We had another one in April of 2021. And currently the market starts to cool off again. Interestingly enough, while the price still rises. So it's clearly not the short-term holders that are currently pushing up the price. It seems to be long-term holders, potentially institutional investors that buy up more of the supply. Now, there are two parts to the story, right? There's simply just holding of Bitcoin, but then there's also realizing profit. As in, when Bitcoin rises further and further and does its multiple X returns, that the investors that might have started, say, with 10% allocation of their net worth in Bitcoin, they suddenly see, after all of this increase, maybe 30 or 40% of their net worth in Bitcoin. When that happens, a lot of people just take some profit. They might not completely balance it out again to the prior 10%, but they might sell maybe half of the holding, right? To go from 40% to say 20%. And so we see profit realization whenever the price tends to be very high. So isn't it interesting how those waves very nicely coincide with the price wave? When the price is high, the short-term holders take over. When the price is low, the long-term holders take over. And it might make sense to buy whenever the long-term holders dominate the market. Currently, we are neither super heated nor super cheap. I find those models super interesting because even though they don't give us the perfect time when to buy, when to sell, they give us a tendency. And that tendency here clearly shows that we are not as heated in the market compared to when Bitcoin was at 50K 4 years ago. Yes, of course, the price is higher compared to 4 years ago, but the short-term holders are not taking over to the same degree as they had in the past. We can also have a look at the realized cap of long-term holders relative to short-term holders. And again, when the short-term holders take over, we should sell. When the long-term holders dominate the market, we should buy. Now, nobody knows exactly where this is turning around, but we can use models like this just to adjust our portfolio weighting. So let's say there's a lot of short-term holders, we might own less of Bitcoin relatively speaking. When there's a lot of long-term holders, we want to buy more. So in other words, we can just adjust our weighting along this portfolio line. So we could look at our exposure to Bitcoin or to crypto, maybe once a month, maybe once a quarter. And we have barely any Bitcoin when the blue area is very small. And we've got much more Bitcoin when there's more blue area shown in this chart. In other words, this could be our portfolio weighting, right? Very low over here, very high over here, and then we just adjust. As the price is going up and the long-term holders realize less and less, we are taking profit, and then once this turns around, we accumulate maybe once a month, etc. Until we had a similar relative portfolio weighting at this point as we were over here. What is nice about Bitcoin is that the market structure tends to be quite stable over time. So it's not like the whales are taking over all of the supply or the small investors buy everything and the whales exit. It seems like there's some kind of a stable equilibrium. So what we see over here is the supply held by different wallet sizes. So in red, again, is the shrimp. So there's a lot of shrimp wallets, but they don't own all of the supply, right? Only 1.4 million. Then there's the crabs, they own 2 million. Then there is the fish, they own 2.5 million, etc. This seems to be relatively equally split. It's not like the whales are dumping on everybody else. It's not like the small retail investor suddenly exits. And again, we can see how the supply that's held Bitcoin for at least 6 months tends to sell off during bull markets and tends to accumulate during those other phases. Currently, in the last few days, it seems like there is some accumulation again, despite the price going up. Now, in general, the game becomes more and more complicated and more dangerous the shorter we hold, right? If we buy Bitcoin and we hold it over 3, 4, 5 years, there's a very small chance that we're actually going to lose. Once we trade more actively, there is a real chance to potentially lose. And no chart shows this better than this one here. This is the net realized profit and loss breakdown by age. Now have a look at the wallets that have held Bitcoin for 6 months to 1 year. When things are going good, those wallets take profit and are happy. But once the market turns around, then those wallets realize massive losses. So sometimes things are good, sometimes things are bad, if you're trading actively and if you don't time the market right. This is still true for the wallets that hold Bitcoin for 1 to 2 years. It is much less true for the wallets that held Bitcoin for 2 to 3 years. They barely realize any losses. Most of the time, when those investors move their Bitcoin, they are realizing gains. Once we go to the 3 to 5 year mark of holding period, there's basically only profit taking. The only reason to move Bitcoin is to realize profit. When things are going down, this wallet cohort is not realizing losses. They simply just continue holding. And so that's probably why the price is going up over time, right? The tokenomics of Bitcoin are that attractive. The supply is pretty stable while fiat currency continues to inflate. Fiat money tends to devalue. We can simply just park our money in Bitcoin, at least parts of our wealth, despite the volatility. And then when prices go higher and higher, we just rebalance the portfolio and we realize some profit. This is the easy way to ride those waves. The more active you get in the market, the more edge you need to have, the more you need to be informed. If you are okay to just wait it out, and if you're okay to hold for 3 to 5 years, you can just realize profit every now and then. And that's all you do. When the screen shows a red number, you don't do anything. When the screen shows a green number, you might consider selling and then maybe use this for consumption or use this to allocate towards other asset classes, maybe buy a house. Things like that. Now, the vast majority of people in crypto approach the market in the wrong way. Most people try to find those multiple X returns. They try to find the few assets that make outsized wins. But this is clearly a game against the odds. Most altcoins tend to go down massively. A 70% decline over here, another 80% over here. It's all double-digit losses. Now, the common counter argument is that maybe we don't just buy 1 or 2 altcoins, maybe we buy multiple and then we might get that high flyer as well. But the problem is that diversification, so spreading the risk across various assets, does not work with altcoins. Everybody can launch an altcoin. Everybody can increase the supply as they want. And so in aggregate, the altcoins tend to do worse compared to Bitcoin and Ethereum over the long term. What we've got over here is the others dominance. So how much of all of crypto is in the altcoins that are not in the top 10? And 3.5 years ago, this was still at 19%. Now it's below 8%. So had you invested in a broadly diversified basket of altcoins, you would have on average underperformed the market by 60%. Instead of trying to find the needle in the haystack and most likely lose, at least in the long term, Isn't it better to try to get the odds in our favor? If most things don't perform that well compared to Bitcoin and Ethereum, if a lot of altcoins inflate in supply over time, so supply grows faster than the demand, then why don't we bet on relative valuations? It's a bit more complex of a game, but I believe that this added complexity does help. We want to make our investing as simple as possible, but not simpler than that. And so here I am doing something differently to most other YouTubers. Most crypto YouTubers, they just show one single win. They say, here, I made some money over there. Just trust me, bro. Very few are willing to share their trading history. Now, here's my trading history on Hyperliquid. This is where I started trading decentralized perpetual futures. This is the profit and loss. And the maximum drawdown was only 5.1%. Now, obviously, I'm not going to share my positions open here on YouTube. That's part of the premium membership. It's down below. It's thebitcoinstrader.com. Now, the issue with trying to pick the winners is, of course, that we have a very low chance of succeeding. But the beauty of crypto is that it's still an incredibly inefficient market. People always say that capital markets are efficient, but in the end, it's the people that make it efficient. So if you know more than the average market participant, if you do more research than most people, if you're part of a group of people that do more research than the average market participant, then we can win. Then we are the people that make the market efficient, then we are the ones that make the profit. For example, this here. This is pure inefficiency. This chart shows the balancer token relative to Ethereum. A very constant underperformance. And we can make money from that underperformance. As the price is going down, we are printing money. Yes, we are betting on falling prices. And yes, this might be a bit more scary at first if you don't know what you're doing, if you haven't yet learned about this whole topic. But the risk is every now and then a potential short-term pump, again, when we bet on falling prices. But the reward is a very long-term constant trend. We can also turn this chart around. So this is now Ethereum relative to balancer. So we're basically buying this when we long one asset and short the other. So the inefficiencies are not necessarily that obvious in the macro, as in the market is expanding and contracting in a way that's not that predictable. But the relative valuations are much more predictable. The risk to reward in a chart like this is quite obvious, isn't it? People make all kinds of mistakes. People, for example, also just leave their stable coins in their wallet. Right? Let's say you trade actively, you've got some stable coins, and you don't use this for anything to add some additional return. That's also a mistake. For example, here we can get 15% APR by providing liquidity to Hyperliquid, the largest decentralized perpetual futures exchange. It's comparatively safe. It's definitely worth the risk for 15% APY. And so this is then the feedback that I get in the chats. It was the first nice trade. Thanks, Gerhard. Then over here, a few more positive trades, etc. And people make their money back very quickly. Premium has already paid for itself. And yes, if you've only got a few $100s in crypto, this is probably not worth it. But if you're investing several thousands of dollars and you're still inefficient in your trading, if you still hope for your one altcoin to outperform, it probably makes sense to learn a bit more. And this is what I mean by learning. I've published more than 100 tutorial videos on various topics within crypto, on how to use relative valuation bets, on how to manage risk, on how to do on-chain analytics. Feel free to binge watch all of this. And of course, I'm also sharing my own trade. So for example, here is a trade opened on the 30th of April. And here's then how I closed this 5 days later. Yes, this is only a single example, but that's why I showed the overall portfolio chart before, right? This one over here. And so feel free to check it out. It's currently $125 per month. It used to be 165 when everybody was super hyped about crypto. Currently, the attention on crypto is rather low, and so the price is also lower. If you lock in that price now, you will not be affected by the price increase that might happen once the market picks up again. So everybody that signs up locks in their current rate. If it's your first time here, feel free to subscribe. I publish here regularly. Like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. There should be somewhere a card over here. You can just click on that and it will lead you directly to the sign up page. So see you over there as well. Cheers.